Welcome, welcome. Give us here a couple minutes. I've got 2 minutes until the hour, and we will start promptly. For those of you who have attended before, we always do the always anxiety-inducing tech check. So I want to make sure you can see both me and perhaps most importantly, Russ. Thank you, John. John's already done it, so jumped ahead and can hear us and see the screen. So I think John hopefully preemptively knew I was going to ask all of those questions, so that is good. Give us about another minute and a half and we will get started. Hope everybody's having a good day. It is freezing in North Florida, which means about 50. So I know the rest of you are probably a little different. You're probably in pretty good shape, Russ, in Arizona.
We're recovering. We had some overnight freezes for the past couple of weeks, but we're hitting the mid 70s these days during the day.
Okay.
So we're
Well,
recovering.
sure, there are 93% of the people on this call are in a much different spot than
You can be
us.
envious now, but if you come here in July and August, it's 110, and it doesn't even get below 80 overnight. So
we got to do the snowbird thing, sort of go back and forth like
got
everybody
plenty
else.
of that. Plenty of that.
Exactly. It looks like people are super piling in now, so we'll wait another minute exactly and get started. Had a great response to this. I think we'll be almost up to 2,000 people registered for both of these sessions, and so obviously did the one Tuesday, and today will be spectacular, probably life-altering and life-changing, I am sure. But we'll wait here about another minute and get started. All right, I have noon Eastern time, so good morning to everyone and going out west there. We're gonna go ahead and get started. So I am Brian Klontz, President of Charitable Solutions. We've had the great joy and privilege of doing these webinars monthly now, which is amazing, since I think June of 2020. Thought this would be sort of a COVID thing, but hopefully something that has been positive coming out of COVID is we just keep on doing these every month. So I think this is roughly our 40th one. Quick housekeeping. I know this will come up in the Q&A even though I say it, but we do not send out slides. Two quick reasons. One, we had a couple people co-opt the slides for, I hate to say nefarious reasons, but for nefarious reasons. And the second thing is, I think we have about 850 people signed up today. And if you want to have fun, try to send out PowerPoint to 850 different people with firewalls and different versions of PowerPoint. And I'd be on the phone for 3 weeks trying to get those to them. So I stopped doing that. But we do a full recording of these, again, all free. So all 40-ish of our past ones are on the Charitable Solutions website that you can download. So bottom line is we're going to talk about the sound of one shoe dropping. Depends, I guess, how big of shoe and how far it drops, but this is a pretty big shoe dropping from a pretty big distance from the IRS. So Russ is going to walk us through the IRS stepping into the DAF space and what that means, both with sort of foundational information from 2006 through some notices and through the proposed current regs. So I do have to cite our 20th anniversary, January 15th. Our Tuesday webinar was our 21st anniversary, but I did pay a graphic artist a not so princely sum to do our special 20th anniversary logo. So we're going to keep that on here for a while. So get my money out of it because I am cheap. And then we have Russ Willis on again. He's our internal due diligence lead on all non-cash assets, anything that's sort of regulatory, legislative, and obviously he'll be leading us through today. So with that, many of you know I do a quick, I hope, update propaganda on things that we do beyond just these webinars. And so for 21 years exactly, our mission has been to help make charitable gifts happen that otherwise wouldn't. Do that through risk management, hopefully background, but also in structure. We have a team of 27 people as part of Charitable Solutions now, and these are sort of the 6 primary areas that we focus in. So sort of more traditional left to right, the non-cash asset risk management. We do both direct consulting, had a question about 30 minutes ago on that, where we just charge an hourly rate for any kind of non-cash consulting. And then primarily, probably 95% of our time is using our outsourced option, the Decami Foundation and related supporting organizations, Decami Asset Trust and others, to receive non-cash assets that otherwise charities were going to decline. So instead of saying no to we always say a good donor with a good asset wanting to do good things, don't say no. We potentially can review that asset to the extent that we are able to receive it. It comes into our donor advised fund. We're on the chain of title. We do all the accounting, all the compliance, all the good fun stuff that Russ helps us with and the rest of the team. And then most importantly, once it is liquid, any kind of exit or liquidity, we do not manage anything once it's liquid. And then that then is granted out of that donor advised fund back to 99% of the time, the charity that the donor was trying to give it to in the first place, or charities. So we're agnostic as to where it goes, but 30 days later, it's being granted out. So it's a giant, in essence, pass-through donor advised fund for these more complex gifts. We also do direct donor advised fund investments into illiquid type assets as well, and or long-term hold positions. That's about a third of our current assets. Our non-cash life income gifts, we do those as well for CRTs and CGAs. We are now serving as a trustee for CRTs, have a full platform to be able to do that with a turnkey model where we do everything, and or can also work with outside investment managers. And then about 4 billion now, over 4 billion, completed in this way. So I've got a little one slide after this to go through our hot off the presses 2023 activity. But our average donation is 5.2 million. So these are chunky. We do about one a day and get about 8 to 10 referrals from charities each day. So 8 to 10 referrals, but complete about one. And you can see there the average fee is about 1.2%. So at the end, once it's liquid, on average, we have a lot of big ones that'll skew the average a little bit, but 1.2, we'll say to 1.5%-ish. Then that's held back as a donation. It's a fee to Decami Foundation, and then all the rest, 99 cents roughly on the dollar, is then granted out. So that is primary activity for non-cash assets. And we do much the same thing for gift annuities. So we have the National Gift Annuity Foundation, totally separate entity, in all 50 states, over 800 contracts now, growing very, very quickly. We then are the issuer of the contract, manager of the contract, do all the sausage making stuff that most charities don't want to do. Can also give to multiple charities within one gift annuity contract. But the point is 100% of that residuum can then be granted back to the charity or charities that the donors want. So again, an outsourced platform for gift annuities. We also do risk management of existing pools, not ours, but for other charities. We have 2 actuaries on staff, basically do stress testing of pools, a full risk analysis, hopefully being able to minimize risk, optimizing the final residuums. And in particular, look at very large gift annuities that represent concentrations for different risk management, which may include reinsurance design and placement as part of that brokerage. So where that makes sense and fits. Charitable appraisals, so we have 4 people on that team. Our tagline is, if you can give it to charity or to a CRT in any way, or as part of an estate, we can appraise it. So we only do charitable appraisals. As an example, I don't even think I included this on here, and I should. Revocation of life income interests. Russ does that. I do virtual currency, life insurance, and again, we've got a number of business appraisers on the team as well. Precious metals, artwork, other tangible property. So all qualified appraisals in that space. Next, emergency assistance funds and administration. So I created a charity about 12 years ago now called the Emergency Assistance Foundation. We have about 160 staff on that side now, 350 funds, about 12 million employees. So these are individual funds, field of interest funds that are potentially impacted by the new proposed regs, by the way, that can make grants to individuals for disaster relief and for personal hardships, where each company creates their own fund. It's a public charity. They get the deductions, and then the grants are tax-free. And then finally, doing things just like this, which are advisor CE in person or virtual, or training for board staff, nonprofits, or donors. So those are the various things that we do. All of it sort of is under the or on, I guess, the Christmas tree within the mission of helping make charitable gifts happen that otherwise wouldn't. That's why we get up every day. So to that end, one more slide of propaganda, and that is what was our activity for last year. This is 2023 activity. 100% of these gifts were declined by the referring charity. That's the only reason that they referred the gift to us, is because they were not able to take it based on their gift acceptance, maybe a very quick turnaround, overly complex. For whatever reason, they said, wait, we can't take it, but there's this weird group in this wonderfully specialized world that does these types of things. And so they then referred in roughly 8 to 10 a day, as I mentioned, complete about one a day. It was 175. It's going to be probably closer to 180 when all the dust is fully settled. We're still digging out a little bit, but 175 known. And you can see there 1.1 billion in donations, all of which were declined. And I don't want to say none of which would have happened, but probably none of which would have happened. So within that deconstructed, about 37 of those gifts were real estate. You can see the business interests are 90% of what we do. Last year, they were 90%, the year before 90%. You would think that 1.13 billion would be our record. Weirdly, it is not. 1.177 billion is what we did 2 years ago. So if somebody would like to send a $45 million check and backdate it, I'd probably cash it. And then that would make it our record for the year, which nobody's probably going to do. But 90% of that is business interest gifts. And that then is broken down by C Corps, 16 for 442 million. S Corps, you can see there 254 million. And then LLC, LP, and GP interests. If you take the 1.13 billion, divide that by 175, you should get, based on my solar calculator, about a $6.3 million average donation. These are average donations. These are all outright gifts. None of these are CGAs or CRTs, which is a different set of data. You can then see cryptocurrency. Everybody wants to talk about it constantly. We did 11. So 14 million of 1.13 billion, I think that's a touch over 1%. So everybody wants to talk about it. Talk about business interest gifts. That's where all the wealth is. Cash, these are only cash that we're receiving directly from the donor to do direct investments into real estate or other private business interests that they wish to make within their donor advised fund. So we don't normally take cash in for any other reason, nor do we take any marketable securities. That is not what we do. And then a couple other weird things that popped up last year too. So that's our activity, and appreciate everybody making those referrals. And let's jump right into the agenda. I think I'm in good time. I'm in right on time, Russ. Hit my time mark there. So as I mentioned earlier, the agenda is going to be a brief history. So certainly needs to have some foundational information, primarily around this 2006 legislation. Next are proposed regs. So that's really what we're going to talk about, the thing that's got people the most concerned. Those comments were due, I think, as of a day or two ago, maybe even today, I don't know. But that has been extended for 30 days. And one thing I want to be very, very clear about, the 2006 legislation was from 2006, and now we're getting proposed regs 17 years later, and this is proposed. So as Russ goes through, if this is any way similar to our Tuesday call, people will say, what about this? What about that? These are all proposed, so certainly not in final form. So there'll be a number of things that Russ will be sort of explaining and teasing out a bit that may freak some people on this call out, as it should, frankly, because as Russ said, the hammer is coming down or the shoe is dropping, and it's a big hammer and a big shoe. But these, again, are proposed. So the key point is what comes next. And most importantly, don't sue us. These are free. Check with your advisors about any of the potential impact of these proposed regulations on your clients and or your charity. So with that, I will do my best to answer Q&A as we go along. There might be certain things I might chime in as Russ goes through. And certainly if it might be important for a Q&A, I can interrupt Russ and we can sort of take that as we go as well. So with that, Russ, we'll jump right into the always fun 2006 legislation.
All right. Thank you so much, Brian. Based on our experience Tuesday, there is what's going to feel like an avalanche of information, but I'm going to try to filter this in such a way that you can actually sort of absorb it. What we are talking about are proposed regulations, as Brian says, after a 17-year lag from legislation that was enacted in August of 2006. And this was part of a larger package that included not only donor advised funds, but also supporting organizations. So there was a perception, and this effort was led largely by Iowa Senator Chuck Grassley, who's still there, to bring some accountability to those two areas, because as you may remember, and as a lot of people probably still feel, supporting organizations and donor advised funds are kind of like private foundation light. You're not subject to the many restrictions and excise taxes, or you weren't in 2006, that apply to private foundations, but donors kind of feel that they have almost the same level of control. So that's the environment in which Congress took action. And what they wanted to do was to, quote unquote, this is literally language from the statute, improve accountability of donor advised funds. How they wanted to go about doing that was to impose new reporting requirements on donor advised fund sponsors on the one hand, and then also to impose some excise taxes on a limited set of transactions that they felt, Congress, I say they, Congress, felt were inappropriate for donors to be able to control when they were also claiming a deduction as though they had made a gift to a public charity, because the fund sponsor is a public charity, not a private foundation. So the first thing the statute did was to define what is a donor advised fund. We've had these around for 50 or 100 years. Somehow I just lost my sharing of the screen here. We've had these around for oh my gosh. I have to go back to sharing the screen, folks. We've had these around for 50 or 100 years. But there was no regulation, and there was none of these. Yeah, I'm sorry, Brian. I'm distracted by the fact that I have, and I don't even see the opportunity to show the shared screen. So we were really hoping that this would not be the messed up version. Okay. 50 or 100 years we've had these around, and but there was no regulation. And so what they wanted to do was to define what is a donor advised fund, and to Brian, I'm not seeing the shared screen
right now.
And as a result, I'm having a there it is.
Yeah, sorry about that. I just had a transformer go out. So that's always nice right
Okay,
before
all right.
So all
we
good.
we now have a definition. We'll back up there. Back up a previous slide, because that's the one I got stumbled on. All right, so and it kind of matches what we all thought a donor advised fund was. It's a fund or account that is somehow identified to a particular donor, and there's a public charity, 170C organization, that is not a private foundation, not a type 3 supporting organization, and so forth, that is sponsoring this fund. And because of record keeping and some promises that were made, this fund is separately identified to the contributions of one or more donors. And those people have some expectation that they will be able to have their voice heard with respect to how the fund is distributed and how it is invested. So now we can page ahead to the next slide, and we won't have this stumble. Okay, there are some things that the statute itself says are not included in the definition of a donor advised fund. And this becomes important when you see the excise tax side of this thing. If it's not a donor advised fund, it's not going to be subject to these excise taxes. If it is, then it is. So what are excluded? Well, if you have an account that is distributable only to a single identified public charity or government entity, that's not a donor advised fund. If you have a fund with respect to which the donor does have advisory privileges, but only with respect to scholarships, fellowships, travel grants, and so forth, and that fund is actually going to make distributions to individuals for those purposes, but in service of charitable purposes, And that donor is a member of a committee. The committee is appointed by the sponsor. There's no combination of donors or advisors that controls the committee, directly or indirectly. I've highlighted that language because that matters how that's defined, and that is an issue that's addressed in the proposed regs. And there's a pre-existing flow chart that tells you what your criteria are for awarding these grants. Okay, those kinds of things are not going to be treated as donor advised funds if they meet those requirements. And the statute actually allows Treasury to create further similar exceptions, and they did. We'll talk about Notice 2006-109. So then we have, if we know what a donor advised fund is, then we start looking at these excise taxes. 4966, which is going to be our primary subject when we get to the proposed regs, imposes an excise tax on something called taxable distributions, sort of a circular definition. What a donor advised fund cannot do is make distributions to an individual. That's what those scholarship and fellowship funds are for, okay? Or it can't make distributions for a non-exempt purpose, something that would disqualify the recipient for 501c3 status if they were exempt. And it can't make a distribution to any other entity other than a public charity unless the fund sponsor exercises expenditure responsibility. For this, we just cross-reference the existing statutes that apply to private foundations. So what about this exception for public charities? Well, it has to be something other than a non-functionally integrated type 3 supporting organization. That, incidentally, is a category that was created by the same statute. You could, in theory, make a distribution to a type 1 or type 2, or even a functionally integrated type 3 supporting organization, but only if that foundation, that supporting organization, is not, again, here's this magic language, directly or indirectly controlled by the donor or a donor advisor or people who are related to those folks. And the statute allows the Treasury to reach in and make some determination that there is some other class of supporting organization that might also be an inappropriate distributee from a donor advised fund. We haven't seen what exactly that's going to look like yet. But also within this range of exceptions, public charities, there's also the fund sponsor itself, which is, of course, a public charity. Let's say a community foundation, for example, could make distributions from a DAF to itself or to another donor advised fund, which is, a fair amount of what Brian was talking about that Jacomai Asset Trust does. So let's take a look at the rest of the 2006 legislation. There's another set of excise taxes. Actually, two others. So we'll talk about them both. 4967, which we have not seen the proposed regs on yet, forbids and imposes an excise tax on something called prohibited benefits. If a distribution is made from a donor advised fund that somehow creates a more than incidental benefit for what I'm going to call disqualified person, because it's such a broad class. It's the donor, it's anybody that's been designated as a donor advisor, and it's a whole group of people that are related to those folks. So it's anybody who holds advisory privileges or a member of the family, and they've actually broadened the definition of member of family just for this purpose under 4958 F7 to include not just your ancestors and their descendants and the spouses of those people, but now also siblings, the donor's siblings and their spouses. And there's also another group of people who could be disqualified persons, and that is any entity that is 35% or more controlled by any of the people I just named. But, and here's a sort of a saving thing, and you're going to see this becomes important, the excise tax under 4967 will not be imposed if IRS has already imposed a penalty under Section 4958, the excess benefit statute. So we're going to have to pay attention to that. So what do these excise taxes look like if they are imposed? We have a taxable distribution. Remember, that's to an individual or for a non-exempt purpose or to a disqualified entity. That is a 20% excise tax on the fund sponsor itself, not the DAF, the fund sponsor. In addition to which, there's a 5% excise tax on any fund manager who knowingly approves this taxable distribution. That 5% excise tax can be applied separately to each and every fund manager, whoever those people are, who participated in approving the distribution. But each of them is also subject to a $10,000 ceiling on that excise tax. We're going to talk briefly about, how many multiple people might be fund managers who could be separately tagged with this excise tax. Under section 4967, the prohibited benefit, remember that's any benefit to a disqualified person that is more than incidental. And we'll get very concrete about that in a moment. That excise tax is punishing. That's 125% of the prohibited benefit. And that's imposed on the advisor, anybody who participated in advising that distribution be made, and on the recipient, the disqualified person who actually got the benefit. And that excise tax is, again, joint and several. So the IRS could be collecting excise taxes of 125% of the prohibited benefit from multiple people. And the excise tax on a fund manager who knowingly approved this distribution is 10%. And again, it's joint and several among however many fund managers participated in the decision. And there's no $10,000 cap. So if you have a very large prohibited benefit, these fund managers can individually be on the hook for pretty substantial amounts. Unlike a similar set of mechanisms over on the private foundation side, there's no opportunity to correct one of these distributions once they've been made. You're simply going to pay these excise taxes and be done. So let's take a look at the next slide, because I mentioned 4958 is also in this picture. 4958 is an existing statute. This was already in place before 2006. It was enacted in 1996, and it applies broadly to any 501c3 organization, public charities, private foundations, and now DAFs as well. And what it addresses is an excess benefit transaction. That's when you have some kind of a transaction between the exempt organization, in this case the DAF, and anybody in this disqualified person class. When that happens with a public charity or private foundation, the question is, well, you hired this person and you paid them more than fair market value for their services. That excess is an excess benefit for which you will have an excise tax imposed, and you should reverse the transaction. With respect to a donor advised fund, the new rule is that you can't pay those folks a nickel. Any transaction with a disqualified person is per se excess. Okay, we're not allowed to pay fair market value even to anybody who's in this disqualified person class. And you remember, that's a pretty broad class. It's related persons, including siblings and spouses, and 35% controlled entities. And by related, I mean even related to the people who've been designated as advisors. 4958 already sent up a signal that people should have been aware of and are definitely going to now have to pay attention to. And that is that they have defined in the statute as a disqualified person an investment advisor who is not, quote unquote, an employee of the fund sponsor. Okay, so we're going to see how that plays out in the proposed regulations. If you do trigger an excise tax under 4958, that's 25% of the excess amount, which in the case of a DAF is the entire amount, on the disqualified person who received the benefit. And again, that's joint and several. However many disqualified people are involved, each and every one of them is separately liable for that 25%. Let's back up a second here. I think we accidentally advanced a slide. And then 10% on an organization manager, which in this case means the fund manager, who knowingly participates. That language was already in the statute, but as we will see, the question of what does knowing participation mean is maybe changing with respect to donor advised funds. So let's move forward because we don't want to get bogged down here. We do have the actual proposed regs to talk about. Some other stuff that was in the 2006 legislation, DAFs are also now subject to the excess business holdings limitations. You can't have a position in a closely held entity if the DAF and disqualified persons collectively own 20% or more of that entity. And there's some language in 170 itself that says you can't even have a deduction for a contribution to a donor advised fund unless, okay, the fund sponsor is not a type 3 non-functionally integrated supporting org. That's sort of a given. But the contemporaneous written acknowledgement has to say in so many words that the fund sponsor has, quote unquote, exclusive legal control over contributed assets. There are live tax court cases where people have lost very large deductions because the CWA did not have that language in it. So, and how this ties into the question of the proposed regs, as we will see, is we now have a definition of donor advised fund that is much broader than we thought it might be. And so people might be getting CWAs from an organization that didn't think it was a donor advised fund, and it won't have this magic language in it. So I did mention that there's also a reporting requirement in the 2006 statute. Any fund sponsors has some lines to fill out at the top of Schedule D on their Form 990 that says how many DAFs they are maintaining, what's the aggregate value of the holdings in those DAFs, how much did you receive in contributions to DAFs in the current year, how much did you distribute out. Even under what everybody thought was the existing definition of DAFs, I've seen plenty of 990s that do not correctly report this information. And that's a problem that's only going to get worse if we broaden the definition of DAFs. So let's see what IRS has told us in the past, leading up to the proposed regs. They did issue a notice almost right away in 2006 saying, well, we've had new legislation that did two things. It brought some regularity to the DAF space, but it also changed the rules over on the supporting organization space. And so we need immediately to answer some questions for people who are making distributions from donor advised funds into supporting organizations. How do you know whether that is a non-functionally integrated type 3 supporting organization to which you're not permitted to make a distribution, or whether it's a type 1 or type 2 supporting organization that might be directly or indirectly controlled by your donor? How do you know? Well, they created some safe harbors where you gather certain information from the intended recipient to give you the assurances that those conditions are not being that are being met. To the extent you can't get that documentation, you are allowed to rely on a reasoned written opinion of counsel. So that was sort of the immediate need that they were trying to address in Notice 2006-109, but they stepped in and they did more. First of all, they wanted to talk about, well, what does it mean to say that a donor or an advisor or a related person controls directly or indirectly a type 1 or type 2 supported organization? And the answer is, well, if in effect they have a veto power over how the funds are being applied. If collectively, either by virtue of voting rights or by their management positions within the recipient organization, related persons can control how these funds are being managed or distributed, then those folks have control. So that is existing language from the regulations under the private foundation rules. And under the 2006 notice, IRS took occasion to begin to exercise its power to designate some additional classes of funds that will not be treated as donor advised funds, similar to the scholarship and foundation funds we were discussing earlier. In other words, a situation where a donor could sit on an advisory committee and advise distributions that actually end up in the hands of individuals. Okay, so which would be prohibited if it were DAF, but we're going to make some more exceptions, not just scholarship and fellowship, but also employer-sponsored disaster relief assistance funds, like Brian was talking about at the top of the hour. And they also said in this 2006 notice, we are aware that we're changing the rules on how you have to manage scholarship and fellowship funds. If you already have commitments in place that were already enforceable as of August 17, 2006, the date the statute was enacted, we're going to grandfather those things in. But going forward, you need to adhere to the new rules. So that was the 2006 notice. Then there was some further guidance, like 11 years later. Let's look at the next slide. In 2017. And again, IRS was saying, well, we got some feedback, in the early days, 2006, 2007, from people as to what they thought we ought to do in this space. And there are a couple of questions that people felt fairly urgently needed to be answered. So here we are 11 years later, we're going to finally answer these two questions, okay? Under what circumstances are we going to trigger 4967? What is a more than incidental benefit to a disqualified person? Suppose, these are the two questions, suppose a DAF makes a distribution to a charity that has the effect of purchasing a ticket to a fundraising dinner, okay? And if it were happening in the private space, they were soliciting me as an individual to make the gift. They say, well, it's a $100 ticket, $20 of that is deductible, $80 is basically the cost of, renting the hall and putting up this wonderful food. Can my DAF make any distribution to buy me that ticket? How about just the $20 that would have been deductible if it had come out of my pocket? In the 2017 notice, IRS said flatly no. Okay, why? Because even contributing the $20 places you, the donor, in a position of getting an $80 ticket you wouldn't have had access to otherwise. That's a more than incidental benefit. The more substantial question that they were also addressing was, well, suppose I have a donor who has a donor advised fund who has also made a pledge to the recipient organization. And then they come to us and they advise that we make a distribution from the DAF to that organization to which they made a pledge. Under what circumstances does that provide a more than incidental benefit to the donor or the advisor? And of course, the real question is, was that pledge legally enforceable? Are we discharging a legal obligation that could have been enforced against the donor? That would be a more than incidental benefit. Curiously, IRS took a fairly generous position here. They said, well, it's probably too much to ask a donor advised fund sponsor to investigate the question, was this pledge legally enforceable? So what we're going to do is this: you make the distribution, you don't say anything about whether there was or was not a pledge. Don't even mention the pledge, okay? And as long as no disqualified person does receive any other incidental, more than incidental benefit, and as long as nobody then says, oh, well, I've made a deductible contribution, in satisfaction of my pledge, and tries to claim another charitable deduction, as long as those things don't happen, we're good, okay? So that's the position they took in the 2017 notice. But again, they took the occasion to say more than those two things. And that's on the next slide. They said, eventually we're going to get around to regulating in this space. And when we do, we're going to address this question. How does the recipient organization characterize contributions they're receiving from donor advised funds when it comes to calculating their public support test? And IRS said, when we get around to regulating in this space, here's what we think we're probably going to do. If you get a contribution from a DAF and you know who the donor is, any DAF distributions from that fund are attributed to that donor. So if it happens over and over again, that could become one of your 2% donors. But we're going to make it a little worse for you here. If you get contributions from donor advised funds and you don't know who the donor is, all of those are treated as coming from the same source. That can quickly add up to your 2% threshold, okay? And the only way around that is if you get a distribution from a fund sponsor, okay, you happen to know that this is a fund sponsor and you don't want this to trigger your 2% threshold, you need a statement from the fund sponsor that says, this didn't come from a DAF, and none of our donor advisors said anything to us to make us to suggest to us to make this distribution. There's no advice involved here. So that's on the horizon. They have not formally regulated in that space, but they've thrown up the flare back in 2017. So let's keep moving toward the present here. For years, this just sat on the priority guidance plan under a lump saying, one of these days, we're going to issue proposed regulations on these excise taxes. That they said no more. 2 years ago, they said, when we do this, we're going to break it into 4 projects. This is why we're calling this one shoe dropping. because what we're seeing now is just the first of 4 projects that are on the near horizon. We're going to issue proposed regulations under 4966, 4967, 4958, the 3 excise tax things, and we're going to do something or other. It might be proposed regs, it might be notices, it might be a revenue ruling. We're not really sure yet about that public support test thing that we just talked about. So that's what's on the near horizon. And what we have now, next slide, are the proposed regulations under section 4966. How are we doing for time? It's getting away from us again. We're going to try to keep this orderly. Okay, so we have the new proposed regs. The comment period has been extended to February 15th. You're going to hear some things here that are going to make you want to consider submitting comments, I assure you. Okay. So remember what we said the definition of a DAF even was. It's a funder account that's separately identified somehow to one or more donors. Well, under the proposed regs, we're saying, what does separately identified mean? Well, we're going to look at facts and circumstances. There's some internal account bookkeeping that's happening over at the sponsor, okay? And they are tracking these contributions. So that might in itself be enough to identify a fund separately to one or more donors. But also the facts and circumstances are, well, what were the communications between the recipient organization and the donor as this contribution was being made? You know, did we make some suggestion to you that you would have advisory privileges? That's more like we were normally thinking. But this facts and circumstances thing can be broad enough to sweep in some other funds. And that's a recurring theme over the next few pages here. They define donor in such a way that it does not exclude a contribution that might come from a private foundation or a type 3 non-functionally integrated supporting organization. Those people could be donors under these broadened definitions. And as far as whether we do or do not have advisory privileges, again, we're looking at facts and circumstances, all kinds of informal communications that surrounded the gift transaction. And it doesn't even matter whether the donor or any of these designees ever actually exercises these powers. If there was some kind of a understanding that there would be an advisory privilege, then there is an advisory privilege, and this fund is a donor advised fund under these broader definitions. This can include service on an advisory committee, and we're going to go a little bit deeper into that on the following pages. So what we're beginning to see here is that there are funds under management at specifically community foundations that we didn't think were donor advised funds that might be donor advised funds under these proposed regulations. And if they are, then they are subject to these limitations on distributions and these potentially punishing excise taxes on distributions. So in addition to all that, the IRS is requesting comments. Suppose you put some kind of restriction on your gift, and that's a restriction that you as the donor could lift in the future. Is that an advisory privilege? All right, so what all is in the definition of donor advisor? Well, it's important to note that one of the first things out of the box in the proposed regs is they say one of the places you could be exercising an advisory privilege is with respect to how the account is invested. And if you bring in your investment advisor in on that, and that's also the person who advises you on your own private investments outside the DAF, that person is going to be a donor advisor, okay, and therefore a disqualified person, and therefore under section 4958, it will be improper to pay them a nickel from the donor advised fund, even for their advisory services, because any transaction with a disqualified person is per se an excess benefit. Unless, and they do say this in the preamble and in the language of the proposed regs, somehow that donor advisor is quote unquote properly viewed as advising the fund sponsor as a whole, rather than just advising your DAF separately. The example they gave in the preamble is, well, if you have 1,000 DAFs under management and this advisor is advising as to all of them, then clearly he's advising the fund sponsor. That cannot be the only case. And that's one area in which we're going to see a lot of pushback in the public comments. there must be a circumstance under which other investment advisors can be brought into the picture without triggering excise taxes under 4966 and 4967. But again, I had raised earlier this question: what about an advisory committee to, a field of interest fund, or a memorial fund, or a friends of fund, or something? Surely we do want people on that advisory committee to also be contributing to the fund. That's kind of the purpose of inviting them onto the committee. Well, what IRS is saying is, even if you have multiple donors, okay, unless these people are being brought onto the committee because of their particular expertise as to the subject matter under which you're making these distributions, if more than a third of these folks are significant contributors or related to each other or related to donor advisors, we're going to treat this as a donor advised fund, which basically means that if it's a donor advised fund, we can't even be making distributions to individuals. So let's suppose you have a chamber music society. Okay. The idea is to pay musicians. Okay. Depending on how your advisory committee is structured, can't do it. So there are some potential problems in the proposed regs. Let's take a look at the next page. Again, we're going to have to kind of skim over the top of this, but I just want to identify the issues for you. So you may remember there are some exceptions from the definition. There are some things that, even though they might smell like a donor advised fund, they're not a donor advised fund, and they're not going to be subject to these excise taxes. How about a single identified organization, a friends of, okay, private college or whatever? Unless it's a private foundation or a disqualified supporting organization, okay, we can make distributions out to this single identified organization, and we won't be treated as a DAF as long as the recipient organization is not going to turn around and use the money to administer its own DAFs or to make grants. Because if we're making grants, then sort of a two-step analysis. I've made a grant in order to make a grant. The exception does not apply if a disqualified person can advise as to the identified organization's use of the fund. And the position that IRS takes in the preamble and in the language of the proposed regs is that matters even if your donor just sits on the board of the public charity to which these donations, these distributions are being made. That's enough, even though they don't control the board, which kind of doesn't make sense in light of what we just talked about with advisory committees. As long as you don't control the advisory committee, you're okay on the DAF side. But in order to qualify as not even being a DAF, because you're only distributing to a single identified organization, IRS is saying you're not going to meet that exception if your donor sits on the board of the distributing organization. So then they also want to talk about control on scholarship funds and employer emergency relief funds. What does it mean for a donor to have indirect control of the scholarship funds? Well, they're going to look not just at your relatives, your ancestors, your descendants, spouses, and so forth. They're also going to be looking at relationships among the members of the advisory committee. And they are literally willing to go so far as to say, well, if your investment advisor is on the committee, if your lawyer is on the committee, if your accountant is on the committee, those people are in relationship to the donor sufficient that we're going to say you have indirect control. Okay, these are where some of the problems are arising. So let's take a look at the next slide. I took a step for some reason. I'm not even sure who asked them to do this, but they are also saying, well, we will recognize a scholarship exception for a scholarship fund that's maintained by a C4 organization. We're not even going to spend time on that here, except to mention that they're talking about a broad-based membership. They don't want you to set up a C4 specifically for the purpose of getting around the scholarship fund rules. But with respect to disaster relief, they responded to some comments that they had received back in 2006, 2007. They said, it doesn't always have to be employer sponsored. That's fine. We will allow you to set up a non-employer based disaster relief fund. That's fine. But what we won't do is we won't countenance distributions other than for disaster relief. So these emergency hardship funds, which people have been cheerfully setting up because they thought they met the exceptions here, they're saying, well, an emergency hardship is not something that you can put your finger on. We know what a disaster relief is because the executive branch of the federal government has declared a disaster. Okay, they didn't declare emergency hardship for some individual. Okay, that's just something you guys are inventing on your own. So we're not actually going to allow that as an entity that will not be classed as a DAF. And of course, if it's a DAF, then you really can't make distributions to individuals at all. The best you could probably do is make a distribution to a public charity that itself is permitted to make distributions to individuals, but then you have to be careful not to have your donor on the board or on an advisory committee of that recipient charity. So let's take a look at the next slide. Brian, let's take a look at the next slide. I wish I could advance these. Okay, so all of this has been in service of discussing these excise taxes. Okay, and today we're only talking about 4966, the excise tax on taxable distributions. Taxable distribution, again, is to an individual for a non-exempt purpose or someplace where you should have exercised expenditure responsibility, but you didn't. The fun thing is, though, in the proposed regs, that the IRS is now saying distribution for this purpose doesn't just mean a gratuitous transfer. It's not just a grant. It's also any payment, disbursement, or transfer out of the DAF into anybody's hands, okay? So this is another way by which they reach the question, how about a distribution or a payment from the DAF to, for example, an investment advisor? They're saying, well, that's a distribution, therefore it's potentially a taxable distribution, and therefore, since we are identifying an investment advisor who's not properly viewed as an employee of the sponsoring organization as a disqualified person, it's a taxable distribution subject to excise tax. And they're also going to say that there could be a circumstance under which it's not a direct distribution, but there's some kind of a use of assets of the donor advised fund that does result in a more than incidental benefit to a disqualified person. Okay, the example they give is an expense of some kind that is charged solely to a particular fund. That could also implicate this punishing excise tax of 125% over in section 4967. And then after all of that, IRS is saying, it's possible that you could initiate a sequence of transactions that have, in the end, the result of being like a taxable distribution. You make a distribution that on its face is proper to a public charity, but then you're on an advisory committee there or you're on the board, and in the end of the day, the money ends up in the hands of an individual and the donor had a hand in causing that to happen. We're going to collapse the steps of that under a step transaction analysis and treat that as a taxable distribution, even though at any given step it wasn't. So next slide. So again, we're looking at exceptions here. Some exceptions. When is a distribution not a distribution? Well, when it's an investment, okay? But they want some guidance. They're actually asking for public comment. When is an investment not an investment, but actually a distribution? They give the obvious case, or they think it's obvious, of a zero interest loan. You're obviously not putting that money into the hands of the recipient for the purpose of a return because you're not getting a return. So it amounts to a distribution. But they're asking, is there something else? And of course, what they're raising is, how about program-related investments? Okay, or how about program and related investments light, where your return is not as strong as you might have gotten elsewhere in the market? At what point does that tip over from investment into distribution? Okay. They did say, however, that we will be permitted to use equivalency determinations for making distributions from DAFs to foreign organizations. And they're asking for comments on this question about, is there some third or fourth or fifth class of supporting organizations beyond the ones that are already disqualified that should also be disqualified as inappropriate recipients of DAF distributions? So let's move to the next slide. And okay, and another class of exceptions from the distribution rule is if you're distributing to a non-exempt organization, but for an exempt purpose, okay? What they won't let you do is make a distribution directly to the entity that you're distributing. Let's say you would have distributed it to a public charity, but instead you directly support one of their projects. That is not going to be treated as a distribution to the public charity, okay? But if it's for an exempt purpose, it may still qualify. But it won't include any activity that would have been prohibited to your recipient if they were a C3 organization, or which would cause them to lose their exemption if they had one. And again, in these cases, you do need to exercise expenditure responsibility and the cross references to the existing regulations for private foundations. So I think that is that all the substantive stuff we needed to cover? And we'll just get into the excise tax. Again, 20% on the fund sponsor, okay? 5% on a fund manager who knowingly agrees to make the taxable distribution, joint and several, capped at 10,000. Who is a manager? Well, they say officer, director, trustee, or somebody with similar authority, but they also say that it doesn't have to be the final word. So there could be several people up and down the chain of authority who participated in making the decision to allow this distribution to go out, and that any individual quote unquote fund manager could be somebody who's delegated fairly far down the chain. That doesn't have to be the final authority. And also knowingly agreeing could mean that you had the information that you should have acted on and you just didn't act. You didn't act to prevent the distribution from being made. So I've highlighted here something we're going to talk about in more detail on, if not the next slide, then the slide after that. What does it mean to knowingly agree to allow a distribution to go out? And then they are soliciting comments on whether it's okay for a fund manager to seek legal advice and rely on that legal advice to make a distribution that ultimately turns out to have been improper. Let's take a look at the next slide. Okay, so what this all leaves us with, and we will talk about knowledge on the next slide, are any number of open questions that we've identified along the way, but I want to just kind of focus our attention on three of them. One, there's a large class of funds that might be treated as donor advised funds if these proposed regs go final, okay, that we didn't think were donor advised funds before, okay? And a lot is going to depend on your advisory committee structure. You know, who all participates in deciding how these funds are used. Could be a field of interest fund, whatever. And within that advisory committee, what does it mean for any of those people to be a quote unquote significant contributor? It's interesting, IRS raised this question, you know, if you're on the advisory committee and you're a significant contributor, you know, then we're going to treat you as a donor advisor for purposes of this 1/3 control sort of thing. But then they turn around and they say, well, we raised the question of significant contributions, but we don't really know what's significant. They're asking the public to tell them how much is a significant contribution. Another issue that we've raised more than once, and is really going to become important because a practice has developed in the real world in 17 years that is at odds with what these proposed regulations are saying. And that is the status of a privately engaged investment advisor who either is or is not getting paid for their advice that they give in the management of the investments of a donor advised fund. If they are getting paid, it's a per se excess benefit. And also, it could be a prohibited benefit under Section 4967. You'll actually feel lucky if you get tagged with the excise tax under 4958, because then at least you don't have to pay the 125% tax. But the 800-pound gorilla question is going to be under what circumstances can an investment advisor be treated as properly viewed as providing advice to the fund sponsor rather than to the individual fund. Again, this is something where IRS, they created the rule, they say properly viewed in these proposed regulations. They invented that language. Now they're asking us, the public, to tell them under what circumstances is the investment advisor properly viewed as advising the fund sponsor. So the pushback will be in two forms. It's a bad rule to begin with, or what circumstances should make an investment advisor properly viewed. So let's take a look. The next slide is where I really want to focus some attention. Knowing participation by a fund manager. Okay, this is analogous to a rule that already exists under the private foundation regime as to knowing participation in making improper distributions or engaging in improper transactions with a private foundation. But in the proposed regulations here, IRS is changing the rule as to what knowledge consists of. Okay, the statutory language is the same in both cases. Knowing, if the manager knows that it's a taxable distribution. Well, there's an obvious meaning of that, and that is in fact aware. That's the first bullet point under what the proposed reg says. That's the obvious case. But the problem is the reg goes on to say, if the fund manager has knowledge of facts that would be sufficient to determine that it's an improper distribution, and negligently fails to make reasonable attempts to ascertain whether it is or is not an improper distribution, that is considered knowledge under the proposed regulations. That is a more stringent rule than exists under the private foundation regs. And in fact, IRS tried to go that route back in 1971 with the private foundation regulations, and they got pushback and they retreated. And they retreated to an actual knowledge rule. Here they are again trying to go for what the lawyers would call constructive knowledge. If you know the facts that would have led a person who knows the rules to conclude that it's an improper distribution, then you have the knowledge that's necessary to hit you with the excise tax. Under the private foundation rules, it's important that you also do in fact know that X, Y, and Z are an improper transaction. That's missing from the definition here. And the result is that a fund manager who happens to have the facts in hand that should have told a person who knew the rules that it was an improper transaction, that's going to be enough to hit them with the excise tax. Next slide. Okay, all right, so the public comment period has been extended. They've already received, well, they did receive about a dozen requests that caused them to make that decision. Good. That is also the deadline for requesting a public hearing. If they agree to make a public hearing, you'll get about a week's notice to submit a speaker's outline. Here is one of the major problems with everything we've been discussing is that right now, what the proposed regs say is when these go final, they will be effective for tax years ending after the effective date or the date that they go final. And that means that if they do succeed in finalizing these regulations during calendar 2024, they will be effective retroactively to transactions you are already engaging in right now. Okay, there's the address for submitting comments, and we have another slide with links to all the documents that we've been referencing along the way. And also, well, it's the first shoe. Next comes prohibited benefits, 4967, which are already to some extent implicated by the broad definitions they've given us here. We already know that a distribution is more than just a gratuitous grant. And we already know that directly or indirectly can include friends and family as well as just your relatives. And then there will be regs under 4958. I'm kind of guessing those two might come together. And then we will have to see what they do about the public support test. All three of those things are on the near horizon. Then we do have a bunch of links on the next slide to the various sources. Right at the top, there is another webinar on similar content that you might want to take a look at. Brian, over to you.
Yeah, great job. It's a lot to cover. I had a lot of good questions. I was typing as fast as I possibly could. We will get to your questions, even if they are unanswered, and we will compile those with Tuesday's questions, as we always do. We'll have a link that will go out to this recording as well as those combined questions. I do think, Russ, you may have mentioned the Foundation Source did a webinar as well, which I think is on YouTube, that covers many of these areas. So there are a number of people all thinking about the Rubik's Cube facets and impact, and well, wait, what if this, then that, and oh, that's not good. And so we're very much in that, but I would definitely encourage you. This summit webinar in particular talked about how to submit comments, different groups that were doing that. So I'd really encourage you to, and that also you can see the comments that have come out. So ACTech, as an example, state and tax attorneys put out, I thought, a very, very good piece, not yet published, but Russ and I have reviewed those comments around these particular areas and suggested changes that they are making as an association. But obviously there are dozens of comments sort of coming in around this. So I do hope it's helpful. Again, hopefully we got many of the Q&A answered as fast as I could, and here are all of our sort of past webinars as an example, at least through 2022. But bottom line is you'll get an email out here in the next 2 to 3 business days, early next week, with the Q&A, the link to the recording, and we just hope, in particular, given this moment in time, that this gives you at least some history around the 2006 legislation. It took 17 years to get to this point. And now what the potential implications would be in very, very ambiguous language, I think, for people who are even thoughtful in this space. So Russ, great job. Thank you as always, and everybody have a great rest of your day. Thanks. Bye-bye.